Good afternoon, everyone, and thank you so much for joining us for our monthly Meet the VC. Today, we have an amazing event planned for you with Ankur Ahuja from Varana Capital and our amazing host today, David Mashhoodi. Before we get started, just a couple of quick touch points. Actually, first of all, Happy New Year, everyone. This is our first one in 2022, so Happy New Year. I am going to be kicking us off today. My name is Gina Longmire. I started with Early Growth back in 2013. I left briefly and came back in March of 2021 to help run these Meet the VCs. My background is in events and most recently virtual events and back-end production. Today's webinar, for those of you that are joining us, is about 40 to 60 minutes long, depending on our question and answer. Feel free to ask your questions at any time using the question and answer panel. We'll be moderating them and getting back to you as soon as we have a moment to. You can also feel free to use the chat to talk to us or everyone else on the event today. And at the moment, feel free to drop your name, where you're dialing in from, what your company is, all of those fun things. Feel free to even put in your LinkedIn profile if you'd like to connect with one of us or anyone who's on the VC. Today, it is going to be recorded, so you'll be able to view this on YouTube. We'll be having this put up on our YouTube channel tomorrow, so if you have to leave at any time or you missed any portion of this, you will be able to log on to YouTube and see it again. Before we get started, just a quick couple touch points, about Early Growth. We are an organization that takes your company from startup to exit. We want to be your company's one-stop shop for essential business services at every stage, from CFOs and strategic finance to accounting and human resources. We want to take care of all of your back-end services and get those done for you so that what you can focus on is what's most important, and that's growing your business. Here's just a couple of the organizations that we work with. We have over 5,000 clients, and we are happy to serve them on a daily basis, and we would love to work with all of you and serve you as well. What we deliver here at Early Growth is peace of mind. We provide you with one-on-one solution for all of your needs, including CFO services, HR, accounting, taxes, and insurance. We like to protect your profitability. We give you a sole point of contact who can answer all of your questions, as well as strategic dashboards, allowing you to see where your business stands and where your company is heading. We want to be your partner in growth. Like I said, we love to work with you and partner with you to help grow your business so that we focus on kind of the back end and you can focus on your growth side of it. Today, as we kind of kick things off, we want to offer you a special promotion. You can get $500 off your 2020 tax preparation if you go to earlygrowth.com/tax promo. This offer expires 30 days from today, so make sure you head on and take advantage of that. As we kind of get going, we want to ask the question, are you fundraising? Let us know in the panel box, are you fundraising? Do you have any questions on fundraising? All of those good things, and we'll get to them as we go through the event. As we said, we want to be your partner in your growth. And much like we want to be yours, we have fantastic partners that we work with to help ensure that you are taken care of every step of the way. To tell you a little bit about those partners is our moderator, David Mashhoodi, who you can see on the call right here. David has been a business development manager with Early Growth for a little over 3 years. Prior to joining Early Growth, David was a financial analyst at VIP Capital. In his spare time, David likes to hike, and he's even been through both the Pacific Crest Trail and the Continental Divide Trail in their entirety. So now, here to introduce our partners and take over, Mr. David Mashhoodi.
All right, thank you so much, Gina. Appreciate the introduction. Didn't make it in here to actually just welcome our first child into the world, Logan's. He's 3 months old, so still on the bandwagon of kind of hyping that addition as well. Really excited to introduce our partners today. I mean, obviously couldn't do it without you guys. First, maybe starting off with Anna from Trinet. Do you want to take yourself up on mute and give a plug to Trinet? Introduce yourself.
Sure. Thank you, David. Hi, everyone. My name is Anna Evans, and I'm with Trinet. My colleague, Jacqueline Sukutan, is also here today. Thank you so much for including us. We're excited to have this opportunity to learn and hear from the speaker today. What Trinet does is really we partner with early stage startups to help them with all things HR. So think of us as your outsourced HR department when it comes to things like payroll, managing benefits, managing HR compliance, covering things like workers' comp. We help with all of those pieces of the puzzle so that early stage startups can really focus on their growth and fundraising and all the 10,000 other things that they need to do. Some of the clients that we've worked with are, Netflix, Ring, Dollar Shave Club, Airbnb, a lot of the, brand name technology companies that you've all heard of. And we would like to partner with you guys in the same way. So thanks so much for having us.
Thanks, Anna. Really appreciate that. Also joining us is Bharath from First Republic Bank. Bharath, you want to say a few words?
Yeah, thanks, David. Thanks for the intro. Obviously, we've had a fantastic partnership with you guys and as well as Trinet. I'm a director of tech banking here. We're a top 12 bank by assets. We're founder-led. Our founder's still our CEO. I lead the East Coast tech banking team here. So we have something called our toolkit package where we offer 25,000 free AWS credits, 100,000 in Google Cloud credits, 90 basis points to offset your Trinet fees. So we've put together this package so, early stage growth companies can focus on the product and sales, and we can focus on the banking. And there's no banking fees for the lifetime of the relationship. So just tremendous growth. Some of the best success stories in our team, I would probably say, is Zola, Alloy, and probably Instacart. They opened up an account with us for about $15,000 10 years ago, and they've grown with us ever since. So yeah, we're SVB's #1 competitor in the space, and we keep growing year over year. Thank you.
Thanks, Bharath. Yeah, First Republic's been a great partner, and all the clients that I've spoken with love working with you guys. So thanks for partnering with us on this. All right, without further ado, I'd love to introduce today's guest. Ankur Ahuja from Varana Capital has been kind enough to join us today. Ankur, if you want, take yourself off of mute. I would love it if we could start off by, there's really two funds that you could talk about. The Evergreen Fund focused perhaps on a little bit more later stage companies, but also the early stage fund. So if you would, please let us know a little bit about yourself and your background, and then we can start diving into the thesis of those two funds.
Sure. So I want to thank everyone for having me. This is my second AMA, so be easy on me. I had a very serendipitous kind of way that I got into the VC world. I'm a two-time founder. I interned when I was in college at a hedge fund for 4 years for a guy named Philip Brenneman. He invested in my first company, which is a consumer packaged goods company. We later exited that after running that business for 7 years. Prior to joining here, I had a logistics startup that I ran. And in June, Phil called me. They wanted to grow the fund. We had stayed in touch, and he's been my mentor for over 16 years, and said, you want to trade up from being an intern, we have a position open for you. And made my way over to Denver, and that's how I kind of got into the VC world.
Right. So I think you bring one of those unique perspectives to the table, being in the seat of the founder and seeing the business from that perspective. I think we can talk more about that as we go forward. But kind of to back up and talk about the two funds themselves, would you mind walking us through the investment thesis on both of those and a little bit about the fund formation structure?
Sure. So our flagship fund is the Varana Capital Focused Fund. That fund has about $100 million in assets. That fund started in 2011. We started out primarily as a family office to manage the wealth of the two partners, Phil and Ezra. Little by little, friends and other people were like, hey, can we invest alongside you guys? And that kind of grew very organically into what is now Varana Capital Focused. Our main fund is a very concentrated fund. We only hold between 8 and 10 core positions at any given time. It is hybrid in the sense that we invest in both public and private securities. And it's evergreen in the sense it does not have a typical 10-year VC structure. It theoretically will continue on forever. The investments that we've made, we believe that, a 10-year kind of cookie cutter time horizon doesn't really fit the needs of those portfolio companies. So we have optionality to take companies that are private into public, stay on their boards, and continue on the journey for a lot of these companies as they're in the public markets. And so we are in the process now of raising a new fund. It'll be a cookie cutter VC structure. We've done a lot of early stage investing in Israel. We happened to kind of just get very lucky there. One of the founders had Previously ran a small fund out of there. We had really strong deal flow out of there, and we've had a lot of success over the last 5 years, taking companies that are, early stage pre-seed. And, last year we had, I think, 3 or 4 IPO on the NASDAQ. So kind of building off of that success and momentum, we're going to start a $15 to $20 million early stage seed fund that'll invest specifically in early stage Israeli tech.
Specifically in Israeli tech. Okay. So what are the areas of focus in terms of the technology verticals that you're most excited about and are going to be looking at immediately at this fund, this early stage fund?
Sure. So we are sector agnostic, but some of the verticals that we're looking at obviously are EV. The EV space is really hot, but we're not going to invest in a company like Tesla, right? What we would look at in the EV space is component manufacturers. So one of our investments, Arbe, which went public last year, is a 4D LiDAR chip manufacturer. So they make the sensors that go into these vehicles so they can operate autonomously. RE is another great example of a vertical company that's in this vertical that builds this autonomous platform that other tier 1 OEM manufacturers can build their delivery vehicles or their cars on top of. So we look for opportunities that are kind of off the beaten path within these verticals. And that's kind of what's made us so successful over the last 10 years.
And thanks for that. What's the typical check size that you're writing companies? What stage do you like to enter in?
Sure. So with this new fund, we're going to be at, like I said, a pre-seed to a seed A, although these days those lines are kind of blurred between rounds. But we will write checks between 250,000 and $1 million with the potential to do more, and about 15 to 20 million as a total fund size that we're planning to raise.
Okay. And then do you typically reserve capital for follow-on investments as well?
So we're going to reserve between 20 and 25% for follow-on investments. A lot of you guys know in VC, it's all about finding those outliers. So, VC, it's a high risk, high reward game, right? And there's a lot of companies that end up going to kind of what I call donuts, right? They become zeros. And what we need to do is at an early kind of stage, figure out which one of these companies are going to be outliers and have rights to invest on follow-on rounds, to maximize our return for our LPs.
Got it. Okay. So typically, do you guys ask for a board seat? Are you leading rounds, or is it, what's the percentage of follow-on, or not follow-on, but participation versus actually leading in those rounds that you guys are seeing?
Sure. So in terms of follow-on rounds, we have a pretty high rate on our follow-ons. We're not looking to just invest in companies at an early stage and then forget about them. We like to sit on the boards of all the companies, either we or a partner. If we're investing alongside, we invest alongside partners often, and either we or one of those partners will have a board seat. And so we're really exchanging information for liquidity, right, in a private company. And we're okay with that, being in that position, because hopefully that leads to outsized returns. So, we're typically heavily involved in all the companies that we are involved in. We don't want to just write a check. I know that's kind of a very buzzy thing now, right? Which is everyone wants to give more than just a check. But we've been doing it for the last decade, although not marketing ourselves very well that we do this, but we've been doing it for the last decade. And, we really want to add value beyond just capital, right? We want to be able to give our intellectual capital, our networks. We've had a lot of experience. A lot of us are also founders and operators. So we know the gripes that these companies go through on a daily basis. And we really want to be able to help them from the ground up. It takes a village to build a start, and we want them to succeed. And I think that's the things that we're offering a lot of these companies, beyond just the capital, is the secret sauce, I would say, that helps that helps us produce the returns that we've produced for our investors over the last 10 years.
Yeah, well, you kind of stole my next question, which was, how involved are you in these businesses, and what's kind of the value that you can bring to the table? Because I think when looking for, a lead investor in particular, that strategic value should be, at the top of founders' minds. So that's super helpful. Why don't you walk me through what the decision-making process typically looks like at the fund? What diligence is like? How long does the process normally take? And what are some of the key steps in your process?
Sure. So the diligence process can take anywhere from a few weeks to even a month or two. It really depends on the portfolio company that we're looking at, and how prepared are they? Do they have a good set of documents that they have in a place with their financials and with all the information they need? A lot of times things are missing, and so those things delay the process. But we actually, with a lot of the companies that we invest in, we'll start conversations with these companies before they're even raising rounds, really just to get comfortable, right? Because when you're investing at an early stage, you're investing in people, and you want to be comfortable with the people you're investing in. There's been lots of times that we're having these conversations way before they're even raising rounds. And so when we get to a place where we're raising rounds, it could happen in just a few weeks that we do our diligence and make the investment. Other times it takes longer, depending on just the situation. It's all kind of situational. And the way we like to look at our investments is there's always a lead on the team that will be involved, will be the point person that's involved with the company. And then from there, we do have an investment committee that is, we have like regular meetings, and we will bring up the investments and then run through the numbers, what we see, the team, present it to the collective, to the organization, and then make our investment decisions based on that.
Sounds like a pretty quick turnaround on your side. If you get excited about a deal, there's nothing really is going to hold it up.
Well, at an early stage, there's not we're not really looking for a product demo because there is none, right? And so it's really based on people, and it's more of an art than a science, right? And being good at figuring people out and analyzing people is kind of like half of what we do here. And it's exciting. I get paid to chat with people all day, and to chat with people like you, and read and learn. And it's a great place to be, and to get paid for, right? So it's great.
Yeah, if you're inquisitive, if you like learning, it's definitely the place to be in. I think you kind of touched upon it in terms of how important is team. And that kind of leads me into what could be my next question is, I think you bring a unique perspective to the table, having sat in that founder's seat before, having gone through successful exits and growing with it, throughout the life cycle of a company. What typically do you see, what in your mind, what marks a successful investor? What are you looking for when you're, analyzing a founding team and potentially looking at making an investment or a bet on those folks?
At a very high level, we're looking to see what background do these people have in the market that they want to participate in, right? So founder market fit, I guess, is like the buzzword for this. And that's kind of at a very high level. It's something we want to see. And it doesn't mean that if you're starting a startup for like as I was an Excel spreadsheet, that you need to have worked at Microsoft. You could be an expert in your field in other ways. So that's the first thing we look at. The second thing we look at is the culture of the company is really important from a very early stage. That kind of sets the groundwork for the culture as the company grows. And a lot of times, I think at an early stage, that gets lost. It's more about like raising the money and getting the product out, right? And you get lost with the culture, which is really important when you get to later stage rounds and your company goes from 10 people to 200 people. Are they inquisitive? Are they open to advice? Are they humble? Are they organized? And most of all, are they a sheep? We don't want to invest in sheep. Meaning, are they free thinkers?
Maybe say that again.
I said, meaning, are they free thinkers, right?
Free
like
thinkers,
not
yeah,
following the herd. We want people. And if you look at any successful company and successful CEO of a company, they were always free thinkers who kind of went against the grain. And those are the people that I want to be fighting alongside in the trenches.
That kind of answers my next question to that.
I'm sorry, David. I'm taking away all your
good.
questions, man. I apologize.
I think you can expand on it, but I was going to ask what are maybe conversely, like what are the marks of a founder? What are the red flags that you perhaps look for? You mentioned being a free thinker. Perhaps following the herd might be one of those red flags. But anything else that you've seen, like going through a diligence process that's made you maybe turned you off to a deal? And maybe share that with us.
Yeah, I think founders that aren't humble and founders that think they know everything and they know exactly where this company is going in 10 years, knowing too much is also detrimental, I think. And I think that's a big red flag for us, because I'm a big believer that you don't know what you don't know. And, I think that's something we definitely look at. The other thing is just like, how easy is someone to work with, right? And so I remember when I was in NYU and going through those super days for investment banking, they would do something called the airplane test, right? Or the airport test, excuse me, which is like, if your flight's canceled at an airport, would you want to hang out with this individual? And, it's stuff like that we look for. And on top of that, how passionate are they about this field that they're, potentially going into and breaking into? I think those are some of the very high level things we look at, and I know it sounds so simplistic, but it's really kind of the stuff that we do, when we're sitting here and on phones and on Zoom calls with people. This is the discussions that we have when we're sitting at the table discussing whether we should make an investment with someone. And we've passed on investments that could have been great investments because the founders were difficult to work with, and did not want to take our advice, which it's not always right, but we've been around the block a few times.
Yeah, that's a good point to bring up too, because there might be a few founders in this room that haven't raised capital before and are kind of assessing what that route might look like. And everything I've heard is be very wary about who you take capital from, because it is very much like a marriage and a family, and you're going to be tied to that person for a while. So, walk me through like what if you were going to give some advice to founders, what should they be thinking about when picking for instance, an investor, and then someone that might be potentially asking for a board seat as well?
Yeah, I think, so I'll break that into two parts. As an investor, what they should look for is, how quickly do I reply to your emails? How passionate am I about your company and about what you're doing? Am I just trying to like deploy capital and fill a quota that I have, or am I really going to be someone that wants to fight alongside you and is a believer? Those are some of the questions that founders should ask, even at an early stage. That's what I think. And in terms of board members and board seats, look, at an early stage, putting your board together is really important. You want to get people that are going to roll up their sleeves and get involved. You want to choose people that have diverse backgrounds that are going to help the company grow and execute on their mission. I think those are all very important things that startup founders should look for in potential investors and board members.
Yeah, absolutely agree with that. I see a question from Reza. And I wanted to touch upon it more in terms of like the sectors that you're very excited about. I know you spoke a little bit about some EV investments that you've made. What areas predominantly are you focused on, and are you excited about? I know you mentioned you're a generalist fund, but what areas are you seeing, excited about over the next 5-10 year horizon?
Yeah, I mean, it's really cool, right? So we get to sit here and kind of in some ways help shape the future, right? And that's like a really fun job to have, because I want to leave the planet a better place than where I lived in it. And so EV and green tech is something that's like a big area that we're looking at. AI. So we recently in December made a investment in an AI company. I'm sorry, it was second quarter of last year. And what this company does is it doesn't have like an AI software. What they do is they provide the architecture that allows companies to implement AI within their organizations. So, like I said, we look at a vertical like AI, and then we look at all the different kind of sub verticals within that, and we try to go a little off the beaten path. So we wouldn't invest in a pure AI play, but this company in particular develops chips that are going to help power like system architecture servers that will then transmit data back and forth on this AI kind of superhighway and allow programs to run on that. So that's something that we're looking at. Fintech, we're looking at a lot of things in financial services. So there's this stealth investment that we just made, and it's an investment product that's going to come out. Another fintech investment we made in Q4 was a company called Incredi. They're also kind of in stealth mode right now, and they're redefining lending using AI-based forensic accounting, right? So there's no real human kind of person involved in these lending decisions. They'll be automated. You'll basically be able to plug into your QuickBooks or whatever accounting software you use, And very quickly, in a few minutes, this software will be able to tell you if you're credit worthy or credit, not worthy. So those are some of the verticals that we're looking at. We do some biotech, but not a lot of it.
Okay. Interesting. Quite the gambit of investment that you made over time. I mean, would love to learn, like, maybe you can share some examples of investments that have gone very well and what you've learned from that process. But I think more interestingly, like, maybe you can give us an example of an investment that's failed and how you've kind of handled that situation, what you've taken away from that.
Sure. So, I mean, I think the home run that we had this last year was a company called Arbe Robotics. They developed 4D LiDAR technology for vehicles. We've been invested within them for a long time, from a very early stage, have a board seat, and that company IPO'd on the NASDAQ. So that was a huge home run for us. And, the things that we look for, they had an awesome management team that executed, on the company's mission. A failed investment. And so this is before I got here, so this one's not on me. We invested in a semi-private company called Fortress Paper. It's a paper and pulp manufacturer. And that company ended up becoming a donut. And the reason is because the management and the CEO just did not want to take anyone's advice and kind of thought he knew what was best. And we were on the board of that company too. But, when a CEO doesn't listen to his board, what good is having a board? And that definitely was a lesson in investing in people. And that was one of the earliest investments the fund made. And going forward, we have not made investments if we just are not okay with the management team. And some of those companies have, 100x, and we've missed out, but we will rather sit on the sidelines than go through a Fortress Paper, debacle again.
Mm-hmm. Yeah, well, congratulations on the success, and I'm glad that you can distance yourself from the failure as well. That's always good.
Listen, failure is all part of the game, and if there's no failure, you don't have anywhere to learn from. So, not every investment we make is a great one. We've all made poor investments, but something that's really great that what we do here is, after we close out an investment that, whether it went to zero or whether it failed for us, we spend a lot of time sitting here, and kind of having a little powwow, right? Like having a few beers and really chatting about what went wrong. Where did we fall short? Where do we not see something coming that we should have saw coming? And so really going through those failures and analyzing what happened is really important. So, I'm ready for my first failure. That's okay.
Yeah, embrace the failure. Those are where the learning experiences are. Absolutely.
That's what it is.
Yeah, you mentioned being very involved with these companies as you get involved with them. When do you typically see, and maybe this is a shameless plug for the partners on the call, but when do you see founders being the best time for them to start bringing in support and working with proper partners and surrounding them with talent that can hopefully they can offset some of their shortcomings or their bandwidth issues, if you will?
And this is kind of like an opinionated question. For me, it's, at a Series A is really when you have a product that's working, you have some demonstrated, monthly reoccurring revenue. And at that point, I think it's a good time to start really expanding the team and kind of, plugging into those partnerships that are going to help carry you then from there to, the next phase, right, to the exit. And so, companies like Early Growth and First Republic and Trinet, and these are all companies that, I think are great for startups to have, in their back pocket, right? To when they're ready. I think it's a really important thing to have.
Yeah. When they start scaling up and putting their foot on the gas is about the time when it makes sense to leverage partners in that sense. Yeah.
Right. And a lot of times, and I know Early Growth has fractional CFOs and stuff. And I know that, a lot of times you don't need a full-time CFO, even at a Series A, and so not having that additional expense helps. But having a specialist know how to package all your financials for VCs, they know exactly what they're looking for and have worked with, startups day in and day out. I think that's really important to have companies like that rooting for you guys and supporting these early stage companies.
Yeah, makes the diligence process run much smoother, I would imagine.
It absolutely does.
Yeah.
You know, there's some startups that don't even have data rooms, and we're just like, okay, you know, where do we go from here, right? How do we invest in you without seeing anything? And so I think, you know, companies, these partner companies definitely are a big help when it comes to that.
Absolutely. Thank you for that. You know, the topic of valuation comes up very often. I was just speaking to someone about a round that they're raising, and the amount of secondaries that they wanted was a topic of discussion. You know, how important is valuation, and you know, on top of that, when a founder is looking to take some off the table, how do you guys approach, you know, the conversation around secondaries as well?
Yeah, you know, I think this is like the crux that a lot of founders face, right? Is like how much to raise. And it's a double-edged sword, because if you raise too little or too much, I think it's a death wish for most companies. So really being able to kind of tiptoe and figure out what that sweet spot number is to get you to the next phase, right? So you're always giving something up as a founder to get to the next place. And that's a kind of internal, you know, conversation that these companies need to have on an ongoing basis. I think valuations at a pre-seed and early stage, they really aren't worth the paper that they're written on, right? Like you can come up with, I've seen some crazy valuations, and sometimes it's a turnoff for us. But I think it matters less in the beginning, right? It matters more, I think, you know, do you have a team in place that when you do get this capital, that you guys are off to the races? And have you planned that you have enough capital to get you to the next stage that you've promised your investors, right? Because as a startup, I mean, you have a fiduciary duty to your investors. And so that's kind of how I feel and how I look at it when it comes to valuations and that sort of thing.
What about secondaries? Does that turn you off when you see, you know, founders wanting to take stuff off the table?
I mean, I think it's really situational, right? I mean, it really depends on the situation. Why are they doing it? So there's no real right answer to that. But, you know, for us, you know, we really want to understand, why are they making this decision? What's fueling it? You know, is really getting into the mindset of the founder and what are they looking to do?
Got it. Okay. So I know, and I want to mention too to the audience, if there's any questions, I am keeping an eye on the chat board, so feel free to post them and I'll do my best to ask. You know, in this new COVID landscape that we're all in, I think we're all getting used to it in some regard. How has that, in your mind, changed the diligence process and the investment process? Like, have you guys ever made an investment into a founder that you haven't met in person, for instance, before? And maybe talk a little bit about how you see that changing over time.
Yeah. So yes, the answer to that question is yes. Pre-pandemic, it was very few and far in between. You know, I personally would like to sit in front of someone to feel their energy and to feel, you know, what this person's about. But, you know, because of the pandemic, things in the beginning did slow down in terms of the investments we were making. But we very quickly adapted. This is an industry that quickly adapts. And just like we're having this discussion here, you know, we're able to plug into Zoom calls with teams all the time and kind of make investments based on this type of interaction. And I do kind of see this being more and more of a thing that is going to be the future, right? And so less people getting on airplanes and going to go meet founders face to face. You know, I think we've adapted pretty well to it, and it's worked for us. We are on a hybrid in-office, out-of-office model for the fund itself, primarily just because, you know, we like to collaborate in person. It helps the way we work here. You know, there's a lot of just kind of bouncing ideas off kind of sessions where we just sit around and, you know, talk shop. And it's a lot harder to do that on a Zoom, for us at least.
Definitely. Well, that's interesting. I don't hear very often that VCs have made, you know, investments into folks that they haven't met in person. So that's awesome to see that you guys have adjusted to, you know, the remote workforce environment.
And I want to make it clear that, you know, we invest in a lot of Israeli companies. We have a boots on the ground there. That community also happens to be a very tight knit and small community. Israel's not a big place. Everyone knows everybody. So it's pretty easy for us to vet people and for other founders to vet us. You ask around 2 or 3 people and you will find someone that knows the founder that you're talking about, and you very quickly can vet them. And it's a very cooperative environment there, which is awesome for us to participate in.
Yeah. Will you make any investments into non-Israeli tech, or is it strict? Is there need to be some tie?
Yeah, no. So what's really great is, the new fund that we're going to launch in the next month or two, 80% of it will be Israel. The other 20% will be discretionary. And it will be, I think, mostly US based companies, and into some other, different kind of verticals we want to get our feet wet in.
But no geographical preference on the US side, at least for that 20%?
No.
Okay. How many investments do you guys plan on making in, like, for instance, the next 3 months? And, how many have you made over the last quarter, concluding 2021?
Yeah, I think at the end of last year, our portfolio, we added in the last quarter 4 or 5 companies. We made 4 or 5 investments, and they were actually all like in November or December. And with the new fund, our plan is to make between 8 and 12 investments a year, until we deploy all the capital in the fund.
Okay.
We're a small team. We like to sit, we're a small team. We like to sit on the boards. We like to really be involved. And so we have to have a more concentrated portfolio so we can give our time, to all these companies. So I know Phil and Ezra both sit on multiple boards, and, it's a lot of work to sit on a board. It's like basically like having another job. And so, we are limited by the time that we have.
Yeah, absolutely. You talked about it a little bit, but maybe give an example of, it'd be great to hear an example of the time when investment maybe, or a company was going through hard times, and where you kind of went above and beyond for them. So maybe highlight some of the value add, I think, capabilities.
Sure. Yeah, I actually have a great example of this. So there was a company, it was a semi-private, it's called authID, used to be called Ipsity. They had a biometric software to get rid of one-time passcodes. We were investors in the company. Phil was on the board of the company. Company was going bankrupt, or we thought it was going bankrupt. So Phil actually took an executive position on top of his board position. And so he basically had 3 jobs going at the same time at this company. And we were able to actually, what we found was that the management team at the company was really, really shitty. They sucked. But the IP the company had was phenomenal. And so we were able to do a few things. Phil is an expert in raising capital, restructuring balance sheets. We were able to restructure the company, replace the management, and get the stock. It was like a pink sheet stock listed on the NASDAQ. And now the company is doing gangbusters. And it took 2 to 3 years to do that. But that was also a huge home run for us. And that's somewhere where we went like way above and beyond. We helped the company find new hires, help with legal, with raising additional capital to, help their balance sheet. And so we did a lot more than we ever thought we were going to do. It was a great learning experience. If you ask Phil if he wants to be a director of a public company ever again, he's probably going to say no. It's a lot of work for very little glory. But, we did it, right? Because we had a duty to not only our investors, but to the partners that we had at the company. And it was a huge turnaround success. And it's, traded now on the NASDAQ authID, ticker AUID.
It's a great example of going way above and beyond, essentially becoming the management team for the business, at least on an interim basis. It kind of like touches on my next question. I wanted to ask, like, when do you think it's time to advocate or is appropriate to bring in a new CFO or even look at replacing the management team? Do you see that often, or is that really more of an outlier?
It's an outlier. Back in my hedge fund days, in like the 2007, 8, 9, being an activist investor was the way you got on the front of Wall Street Journal. But it's a pretty shitty way to live your life, taking down companies. And so we like to come from a cooperative standpoint. We're not looking to go into a company and replace their management teams unless we really had to. And in this case, with authID, it was a real train wreck of a situation that was really kind of right at the edge of teetering into bankruptcy. So, we don't want to replace management teams. There is some sort of magic that happens with these teams. It's their vision, right? And no one's gonna have that vision beside, right? And so management team and really sometimes suck the soul out of a company, So we're not looking to do that on a regular basis. I want to make that very clear.
Yeah, definitely. In no sense, you're focused like predominantly on seed to Series A with this new fund. Why don't you walk us through like what the key differences are from a product market fit perspective and just overall roadmap between the two, and what really are you looking for as key metrics between the two companies or between the two stages?
Yeah, pre-seed and seed companies, they have an idea, they have a concept. Sometimes they'll have a little bit of revenue or a product that's in beta. But the real difference is by the time a company gets to a Series A, they should really have a fit, product market fit. They should have some reoccurring revenue, and they should have some sort of traction, right? At that point, especially these days where Series A rounds are so much larger than they have been in the past and historically. We really want to see numbers at that point. And that's not to say that, you can't go back and there's always going to be tweaking, right? Until you get to a certain stage, but we like to see that the company has some sort of product market fit by a Series A and that they're executing on that strategy.
I know like
and a pre-seed and seed round, founders get really, I think they walk on eggshells when they feel like, we've told the VC that we're raising on this and then we have to pivot. Some of the best, don't be afraid to pivot your business. Your business the best. And that's not to say that, you start off selling ice cream and then all of a sudden you open a nightclub, right? Like, that's not what I'm saying. What I'm saying is like, sometimes when you get in it, right, and you start that process at a very early stage, you find things that you don't know, right? Like I go back to, you don't know what you don't know. And it's okay to pivot your business. We're actually talking to a company right after this call that is a pivot. They started out as something that was completely different, and they found that their IP and what they've created fits perfectly into the metaverse and into that. And so we're really excited about it. And we don't mind that they had this moment, this aha moment, right? I applaud them for it. Mm-hmm. And it's a really difficult thing, for a founder to do, and to go back to his or her investors and have to give them that story, that story. But I think it's sometimes it's really beneficial.
Mm-hmm. Interesting. Oftentimes I talk a lot of companies about like use of proceeds and what, how much is the right amount to raise. Like how involved are you in that decision making, like that process when speaking with a company? And, have you seen situations where maybe, that wasn't as well thought out and that kind of turned you off to a deal? Can you tell us a little bit more about how founders should be thinking about how they're going to use the money before they approach you?
You really have to know, and that's by doing, your own due diligence, what you need to get to where you're promising someone you're going to get to. And, we see this all the time where companies raise too much, like I said, or too little. And that's a death blow, right? Because those companies typically fail. You raise too much, or you raise at the wrong valuation, you do a down round, you're losing equity as a founder. So these are things that I think founders right now in this very frothy environment, they're just like, I just want to raise money, let me get as much money as I can. And that's the wrong way to think about it. You want to really think about how much do I need to get to where I got to go? And who do I want to go on this journey with? Those are the two questions that I would ask if I was a founder in today's environment. Money is everywhere right now. You see some of these crazy deals that are happening. Even for us, we're kind of taking a step back now and like, wow, this is almost too frothy for us. But I guess that's the way I would answer that question. It's really walking that tightrope, knowing your numbers, knowing your competition. Knowing all this information is key even at a very early stage without a product.
Yeah, that's really helpful. No, thanks for that. I'm seeing a lot of notes in the chat box asking, and I was planning on touching base with you on this, but what's the best way to reach you? If a founder reaches out via email, are you fairly responsive? Do you only take warm introductions? Like what's the best way for people to reach you?
Look, my job is to look at investments. So I look at every deck that's sent to me. I want founders to know that. I look at every email that a founder sends to me. Do I always have the time to reply back? No. We are not only fundraising all the time, we're investing. There's a lot going on here. We have a very small team. We probably get thousands of decks a year. We get 10, 20 decks, every week. I don't have the time to reply to everybody, but I try to. You guys can email me, find me on LinkedIn, on Twitter. I'm happy to help in any way that I can. And yes, I would say, as a VC fund, as a VCer, that's our job. Our job is to look at decks. Our job is to be in touch with founders. And, I'm happy to do it. I'm happy to help in any way that I can.
Great. Great. Well, that's awesome. I'm happy to open it up to the audience if there's questions. I do have one more that I'm curious about. It goes back to kind of the new COVID landscape, and I know like mental health has been a major topic for founders. How do you, having lived that life and been in that seat, how do you think about that for your portfolio companies? And is there anything you guys are doing to help promote well-being for your portfolio companies?
It's so interesting when I look at the days, the 2007, 8, 9, 10, those days of finance where it was like 100-hour work weeks and you grind and no one talked about mental health. And I look today where our, co-founder at the fund here, the other day was like, dude, you look a little burnt out, man. He's like, why don't you just go skiing for the day? You're like, why don't you get out of here and go ski? And so I think that everyone's more aware of it. I think it's something that's in the limelight now, and it's an important thing to discuss. And we don't have any specific program in place now for founders, but one of the cool things with this early stage fund that I'm creating, I will have a partner where, I want to give founders like a $500, here's a teledoc, subscription. And when you feel burnt out and you need to talk to someone and you don't want to talk to me, here's someone else you can call, because a lot of times we experience that burnout, and, it's a rough place to be sometimes and a lonely place to be. So I totally understand that. I'm a big advocate of mental health. And, you have to take care of yourself and put yourself first, because if you're not 100%, you can't produce something that's 100%. And so I'm a very big believer in that. And honestly, move to Denver. You get to stare outside and look at the mountains, 300 days of sunshine. I am the happiest I've been in a long time out here. And so, it's funny, but like choosing where you are, is important, and choosing your lifestyle. So yeah, it's.
In this day and age too, you have that flexibility. So, it's not something you could perhaps do 3-4 years ago. So it's a good point, and a nice plug again for the Denver real estate market. I see.
Which maybe hold off because I haven't bought here yet. So I need a little bit of time.
Well, you got till summer till it warms up enough for anyone from California to get out there. So
right.
I see a question coming in from the audience, and I think I know the answer to this. But do you only invest in companies that are cash flow positive? I'm guessing those are probably more of the diamond in the rough than typical, but what are your thoughts there?
Most companies, right, at early stages are not making any money, and we're well aware of that, and that's the gamble that we take. If you're cash flow positive and you have a venture business and not just the business, so there is a difference. There's a lot of, I would invest in a cash flow positive business personally, right? Because the returns I'd want are a lot. It's a different profile. In venture, when we're making venture investments in a venture related business, we want a lot bigger outsized returns. That's what the LPs want for the risk return profile. Mm-hmm. So it's really rare that we see companies right out the bat be cash flow positive. Typically, when I see companies like that, they are good businesses, and there's no shame in that. My first business was not a venture related backed business. It was a cash flow business, and it was a great business. So I think there is a differentiating kind of thing between the two, and we do not see a lot of businesses that are cash flow positive right off the bat. So
yeah, because if the TAM's that big, then they've probably gone out and raised capital at that point. But they do exist. Correct. Maybe a company's tried to bootstrap. They've gotten a certain amount traction and they're like, hey, we could really grow rapidly if we go out and raise a Series A for the first time?
Yeah, so those
sure
are the
you-
diamonds in the roughs that we're
Yeah.
all looking for, right? And they're few and far in between. And so if someone in this chat has one of those, please reach out to me.
All right. Well, I think that's really, really helpful. I mean, there's no doubt that there's a lot of value that you and the folks at Verona Capital can add. I would implore you, folks to reach out to me or any of the partners at the early growth or First Republic or Trinet side. If we can make introductions to Ankur, would be happy to do so. Let's see. I have a question coming in. Same sense, hopelessness, 3M. Maybe it's more of a comment. Yeah, more of a comment. So, I mean, I think the conversation has been great. Ankur, that's really it from my side. Unless there's more questions from the audience or the partners, I think we've done a good job of kind of encapsulating the value that you bring. Last parting words, I would love for you to kind of, maybe if you have some, words of wisdom that you haven't already shared for our
Sure.
founders, what would be the takeaway in today, for these folks?
There was the last shareholder letter that Jeff Bezos wrote at Amazon, and whether you are an Amazon fan or not, that's a secondary conversation. But he discussed, being different, right, and having to pay a price for your differentiation, and that it's a struggle every day to be that way and to operate your life being different and to not mold into what I call being a sheep. And what I would tell people is founders is you have to pay a steep price for that, but at the end of the day, it's worth it. So keep doing what you're doing, keep your head down, keep building, and definitely rely on people like us to help you guys out and to provide resources that out of your purview.
Great. Well, really appreciate the time today. As I mentioned, if there's anyone on here that wants an introduction, feel free to reach out to us on the early growth side, or, as Ankur said, he responds via LinkedIn. So, feel free to shoot over your deck and try to set a meeting. But
yeah, LinkedIn, email, feel free to reach out to me, guys. Facebook, wherever. I'm always down to help founders. And I have obviously a very special place in my heart, having been one for them. And I know your gripes and what you're going through. And I wish everyone in this chat, potential founders and current founders, the best of luck in everything they're doing.
And I just want to
Awesome.
say, thank you not only, gosh, I can't talk today, to Ankur, but also to David. You both were phenomenal. And as we mentioned earlier, if any of you want to pass this on to your friends or want to kind of rewatch to get any answers, any type of information, this will be broadcast on our YouTube channel later this afternoon. So with that being said, again, Happy New Year's to everyone. And thank you so much to David and Ankur and all of you for joining us. And we will see you soon. So thank you as well to our
Thank you.
partners. Thanks, guys. Have a great day. Bye.
Take care.
You too.